Welcome everyone. What are we going to cover today? Over the next half hour or so, I'd like to make sure that we touch on the following things. First of all, some federal tax law updates. And what do I mean with regard to that? I want to revisit when the filing season starts, as well as where the April deadline is. And they know that just came out last week, and I'm sure most of you know that. But at the same time, this is one of those pieces of information that's really just came out recently. I want to talk about the 2017 federal tax law changes as it relates to hurricane relief. This is a big issue because of what happened this last year. And then Congress passed legislation just in December known as the Tax Cuts and Jobs Act. And we want to visit that because some things are relevant with regard to this year's tax returns. Not much, but some of the things that you need to know about. We'll also cover other tax law and procedural changes, as well as expanded due diligence requirements reminder. This is something that started last year, kind of the enhanced due diligence requirements, but we want to make sure that you folks are very abreast of what's going on with regard to due diligence. We'll talk about expired federal provisions, and this is one of those things that could be changing here momentarily or in the near future. We'll talk about returns with refunds and potential delays. And then we'll talk about revisiting the Affordable Care Act. Of course, part of the Affordable Care Act, or the Affordable Care Act, was something that legislation wanted to take care of and was not able to do so last year. So what's it mean to you? And what's it mean to your taxpayers? On top of that, we'll kind of cover additional things that you need to know. And then we'll finish up with the broader security expectations of tax professionals. This is a real focus with regard to the IRS in this upcoming years. And so one of the things we want to make sure is you folks understand exactly what the expectations of you as a tax professional are. So again, this should take us about a half an hour, maybe a little bit less, and we'll certainly leave time at the end to answer questions for you as well. Let's go ahead and start off with the filing season. Now, this may be old news, but even if it's old news, it's only been about a week that this information's come out. But the filing season will start on the 29th, which is a Monday of January. Obviously, it's starting later than it has in the past, but this is something that you need to be aware of because your customers, I'm sure, are asking this right now. On top of that, the April deadline to e-file an individual return, or to file an individual return, I should say, is actually going to be Tuesday, the 17th of April this year. Why is it the 17th instead of the 15th? Well, the 15th happens to fall on a weekend. And then the 16th is an actual holiday in Washington, D.C. It's Emancipation Day. And because of that, the filing deadline will be for this year, the 17th of April. Next up, I'd like to talk about hurricane relief changes for 2017. This is a big topic because, again, there were some disasters that were related to hurricanes this last year, and we want to make sure that we're covering these things. When it comes to hurricane relief for 2017, first of all, when we're relating to casualty losses, first of all, they must exceed $500. And then they do not need to exceed 10% of the adjusted gross income. On top of that, they may be taken as an itemized deduction or as an increase in the standard deduction. Basically, what we're talking about here, a loss of an applicable hurricane disaster area is fully deductible after reducing the loss by $500. So it's almost like there's a $500 deductible that the taxpayer is responsible for, but then after that, if they are in a disaster area, a hurricane disaster area, the rest is deductible. And the deduction can be taken on either the 2016 or the 2017 return. Now, of course, your folks are working on 2017 return, but if they wanted to do an amendment to the 2016 return, they could do so. Additionally, with regard to hurricane relief changes for 2017, there's a special rule for EITC and child tax credit. So what is it that we're talking about? Qualified individuals may use their 2016 earned income to calculate the 2017 income tax credit as well as child tax credit. On top of that, qualified individuals, this is an important piece as it pertains to the hurricane relief for the 2017 tax laws. Qualified individuals are those whose principal abode was located in a Hurricane Harvey, Hurricane Irma, or Hurricane Maria disaster zone on the date of the relevant hurricane and were displaced from their principal abode. Now, there are other disasters that happen, and we're going to cover that a little bit later. So remember, this is specific to the hurricane relief changes as they in 2017. On top of that, when it comes to charitable contributions, if you have a taxpayer that wants to make a charitable contribution, limitations on charitable contributions are suspended when associated with hurricane relief. It's an important thing to know. There is no limit with regard to that. Additional things to know with regard to hurricane relief changes for 2017. When it came to the retirement-related provisions, this is important to understand. For distributions related to hurricane relief, the 10% penalty for early withdrawal, it doesn't apply. In other words, taxability of the distributions can be spread out over 3 years, and a distribution will not be taxable if recontributed within those 3 years of the withdrawal. The increase to a maximum loan amount will be $100,000. It will increase to $100,000 and allows for recontribution of retirement plan withdrawals for canceled home purchases due to eligible hurricane disasters. So if somebody wanted to take withdrawal and it was for a home purchase and then it didn't happen, they can go ahead and put that they can recontribute to that without any kind of penalty. Finally, with regard to hurricane relief for 2017, when it comes to employers, when employment relief for businesses, please note that it provides qualifying businesses a tax credit for 40% of wages, and that's up to $6,000 per employee paid by a disaster-affected employer from a core disaster area. So when we talk about core disaster areas, of course, it has to do with the 3 hurricanes. So with that, those are some changes specific to the hurricane and hurricane relief for 2017. But let's go ahead and delve into something that's related to it, but also has some other things as well. And that's the Tax Cuts and Jobs Act of 2017. And this is the legislation that was just passed in December. So with regard to the most important thing to understand is that there was a lot of news about this, but most of the provisions in this just passed Tax Cuts and Jobs Act of 2017 will not impact 2017 returns. In fact, these provisions actually go into effect in 2018. What's that mean? There are some provisions, though, that you will need to consider when doing a 2017 return. And what are they? First of all, 100% bonus depreciation. Qualifying assets purchased after September 27th will be eligible. Then medical expense adjusted gross income threshold amount on Schedule A will be 7.5% for all taxpayers for both 2017 and 2018. Interest limitation for home mortgages that begin after the 15th of December when this was passed will now be $750,000. And anything that happened before that time frame, it will be $1 million. Additional things that will impact 2017 returns. First of all, casualty losses for 2016 and 17 other than those 3 hurricanes. So just a couple minutes ago, we talked about the hurricanes. So all the rest of the natural disasters actually fall under this Tax Cuts and Jobs Act of 2017. So other than those 3 hurricanes, here's some things to remember. For losses incurred in 2016 or 2017 that were federally declared disaster zones. Remember, these have to happen in federally declared disaster zones. First of all, in those particular instances, and you're going to see a lot of the same information that happens with the hurricane or the hurricane relief that we were talking about just a couple minutes ago. It's, again, does not exceed 10% of the adjusted gross income, may be taken as an itemized deduction or as an increase in standard deduction. Basically, a loss of an applicable hurricane disaster area is fully deductible after reducing the loss by $500. But not just a hurricane disaster area, any kind of disaster area that's declared by the federal government, okay? And it can be taken, again, on either the 2016 or the 2017 return. Additional things to remember for the 2017 returns as it pertains to the Tax Cuts and Jobs Act of 2017. Retirement distributions related to 2016 federally declared disasters. So again, we're talking about people that had to withdraw from their retirement to help with regard to a natural disaster or federally declared disaster. A couple things to remember. For distributions related to a 2016 federally declared disaster, the 10% penalty for early withdrawal will not apply. On top of that, taxability of distributions can be spread over 3 years, and the maximum distribution of $100,000 that can take advantage of this provision. Now, other tax law and procedural changes of note. And we want to make sure that we understand these things as we're coming into the tax season as well. First of all, the medical threshold will be 7.5% for everyone when itemizing on a Schedule A. And then with regard to Form 8862, the information to claim certain refundable credits after disallowance. A couple things to remember. This incorporates the child tax credit and American Opportunity Credit because they can be disallowed for 2 years. And when we're talking about that, please note that Part 2 pertains to the EITC, Part 3 for child tax credit and additional child tax credit, and Part 4 of the 8862 will pertain to the American Opportunity Tax Credit. Additionally, other tax law procedural changes of note. Please note that on the Form 8867, prepare due diligence checklist. And we're going to talk about this because it's also something we're going to kind of delve into here in just a moment as a reminder of some of the enhanced expectations of you as the tax professional. But regarding the form itself, questions 1 through 8 only need to be answered once if the answer is the same for 1 or more credits. On top of that, there will be some check boxes added just before the questions, and you'll need to just simply check for which credit answers apply. And again, this is for questions 1 through 8. On top of that, there can now be up to 4 occurrences of the Form 8867 on a single return. Not just one, there can be up to 4 different instances depending on how the questions are answered. And questions 3 as well as question 9, they are being reworded for this year. Question 3 pertains to knowledge requirement, and question 9 pertains to qualifying child, what a qualifying child is. So please know these are some changes on the 8867 form itself. But this is a perfect segue so that we can go ahead and kind of discuss due diligence, because this is such an important part of your profession. What is it you do? So we want to delve into that. Expanded due diligence requirements, and this is a reminder because this really did start happening last year, but it's important enough that we want to make sure everyone's still very comfortable about what the expectations are with regard to due diligence. First of all, the 8867 has been completely revised and it's been renamed the Paid Prepares Due Diligence Checklist. Okay. On top of that, it includes questions for EITC, child tax credit, as well as American Opportunities Tax Credit. So one of the things that we want to make sure everyone clearly understands is what the government's trying to do. What is it that they really want out of this? Questions now will concentrate on knowledge requirement, documenting additional inquiries, record retention, as well as whether the preparer asked and explained particular items relating to EITC, child tax credit, and or the American Opportunity Tax Credit. So again, everything's about showing that you have indeed covered these things with the taxpayer. That's the important piece of why this is being done, why this is being expanded, and the expectations are higher or greater of you as the tax professional. On top of that, questions related to qualifying children now exist on the worksheet in the 1040 instructions. Question 2 covers the requirement to ask these questions. So just know that's where you're going to be asked specifically, did you do these things? A penalty, and this is a really important piece, and this started last year, but it's really needs to be in focus for all tax professionals. A penalty of $510 can be assessed for each credit incorrectly taken on a return. $500 per instance, not just on the return itself. So what does that mean? That if all 3 credits are incorrectly taken on a return, the penalty can be up to $1,530 on that one return alone. So you can see when it comes to checking on due diligence, and if that is something that the government happens to want to go ahead and take a look at returns that are being done by a specific individual tax professional, you'll want to make sure that your T's are crossed, your I's are dotted on this, because again, one return alone could hold a penalty of up to $1,530. Additionally, with regard to expanded due diligence requirements, beginning in 2018, this is something just on the horizon, but it's important for you all to know. The aforementioned, when we were talking about the Tax Cuts and Jobs Act, guess what? It'll include a provision that adds prepare due diligence for head of household filing status. So in the end, there'll be additional questions that'll be added to the 8867 for next year. You'll just need to know that's coming. So if anyone's claiming head of household, there are going to be additional due diligence questions asked with regard to that as well. Next up, let's go ahead and talk about expired federal provisions. And here's one of the things that this is a great example of kind of moving targets that are out there. We know that we're coming up on tax season. We know that, you know what, we didn't even know what date the tax filing season was going to be until just recently. Well, guess what? At the exact same time, just before Christmas, a bill was introduced in Congress that would extend expired provisions because some of the provisions are up this year. Now, depending on what Congress does this month, which we're all watching, and this is a great example of why you'll want to make sure you kind of continually monitor through all the different channels that CrossLink provides for you, the following extended provisions may or may not be applicable on 2017 returns. We just don't know, and because Congress needs to work through this during this month. But just to make sure everyone understands what we're talking about here, when it comes to individual expired provisions, all of these are expired at this time, and we're waiting to see what Congress is going to do about that. That includes tuition and fees deduction, exclusion of gain from income of foreclosed home mortgages debt, non-business energy property credit, treating mortgage insurance premiums as qualified mortgage interest on a Schedule A, and even electric fuel cell vehicle credits. Remember, that's expiring. That could have an impact on people that have made a specific kind of purchase, automobile purchase. And then on the business side, there are actually 22 business provisions, all of which are lesser or used credits or depreciation related. But again, they are expiring, and right now they are not in place, but it is dependent on what Congress determines over the next couple of weeks. So again, we'll keep you posted, but continually check in with us. Now, delayed refunds. This is an important piece. This went into place last year, but if there's the thought that this was going away, it is not. It's important for you to know when you're working with your customers. First of all, federal returns claiming any kind of EITC and or additional child tax credit will begin to be released on the 15th of February. So if we open the filing season, or the filing season is opened at the end of January, you have to realize that these aren't going to be processed until the 15th of February. What's that mean? Well, the IRS currently is stating that these refunds will likely not arrive in bank accounts until the last week of February. So that's quite a bit different, especially when you've got early filers. So what's that mean to you as the tax professional? Quite simply, you will receive questions from early filers, and especially since they'll have a perceived normal time frame as to when they can expect their money. Guess what? It's going to be pushed out when you realize that the releases don't even start until the 15th of February. You'll very much be looking at the end of February as to when funding will begin. Kind of a note, the IRS, why they're doing this type of thing, they will be matching W-2 information this year on all EITC returns. Next up, let's go ahead and talk about revisiting the Affordable Care Act. Well, this was quite a piece of news over the course of the last year, and you know what? Now we're sitting there. What's it mean? What's it mean when we're doing tax returns for this year? Well, first of all, Congress did not change, repeal, or replace the Affordable Care Act. We all know that. That was big news. So what does it mean, though? Therefore, everything remains in place for 2017 returns. Everything. Well, you say, well, wait a minute. Weren't they passing some other legislation? They were. The Tax Cuts and Jobs Act does repeal the penalty provision as it's associated with the Affordable Care Act. But guess what? This actually doesn't go into effect until 2019. So you are going to have taxpayers who say, I didn't have insurance, but I don't want to pay a penalty. Guess what? It'll be your responsibility to share with them that those repealing the penalty piece of that legislation, it will not go into effect until 2019. Consequently, penalties do exist for 2017. And guess what? They're even going to exist for next year as well. So educating your customers is going to be an important part of your responsibility if they do not have health insurance. So what's the new rejection criteria with regard to this? Well, first of all, regarding the health insurance mandate, the IRS will reject any silent returns. In other words, what do we mean by silent returns? Well, those are returns that don't have one of the following. Every return will have to have one of the following. First of all, full year coverage will have to be declared on line 61. Or if not, guess what? An amount will have to be entered into line 61, which is derived from the worksheet found in Form 8865, or an exemption is being claimed on Form 8965. It's going to be one of the three. Either the taxpayer has to say he or she had coverage, or there's going to have to be an amount that they're going to be paying based on the formulas that are found in the worksheet, or an exemption is being claimed on the 8965 itself. One of the three. If it's silent, guess what? That's going to be a big red flag for the IRS right there. Continuing on with this, individuals that do not have health insurance for at least 9 months in 2017 or qualify for that exemption we were talking about on the 8965, they will be assessed an additional tax. It comes with the territory. It is still the law of the land. So what is that penalty going to be? The penalty or additional tax for 2017 will be the greater. And it's important to understand it will be the greater of the following. First of all, 2.5% of the individual's income that exceeds their 2017 filing threshold. That's personal exemption, double for married filing jointly, plus standard deduction for the filing status. Or it's going to be $695 each for the taxpayer, spouse, and dependents over the age of 18, plus $347.50 for each dependent that's under 18. And remember, this is the greater of one of these two. So if it happens to be the flat rate, please note the maximum flat dollar amount for a family will be $2,085. However, if, guess what, it's not that, and it's the 2.5% because the person made quite a bit of money, or the household made quite a bit of money, please understand that the absolute monthly maximum penalty for 2017 will be $272 or $3,264 for the entire year for an individual. And again, that's based on that 2.5% because it's the greater, or it could actually be $16,320 per year for a family of 5 or more. So these are some serious penalties that are still out there, and they are still the laws of the land. It is important that as you're working with your customers that they do not have coverage, that they are asking for an exemption based on what their situation was. Okay, a couple of additional things to know. I hope you're all hanging in there pretty good. I think that a lot of this is a lot of information to cover in a very short period of time, but it is important that we also understand these following things. The IRS is now checking that the entire last name matches the Social Security records. So what are we talking about? The IRS will not reject these returns if there isn't a match, but unmatching returns will go to the IRS system. There is a system out there that kind of tracks these. It's a depository, if you will. And that repository will then will have a notice sent to the taxpayers asking them to correct their Social Security records. Okay, so if there isn't a complete match, there is going to be something that's generated and sent to the taxpayer. On top of that, this will also delay the processing of unmatching returns, which will have an impact on when the taxpayers receive their refunds. So guess what? If their Social Security number doesn't match their entire last name, you can expect that there to be a delay, because again, it's going to go through this repository system, this AIR system, and something's going to be sent out. Okay, it's not going to reject, but it's going to slow that processing. Presently, the IRS only rejects returns if there's a mismatch of the first 4 letters of the last name. That's always been the case, but now they're looking for the whole thing. They won't reject it, but they are going to send notice out to see if those records can be fixed or matched up. Okay. Now, the IRS began doing this updated matching during the 2017 filing season, and they're going to continue for the next foreseeable future for sure on that. One other additional thing to know is the W-2 verification code pilot. This has kind of been an interesting program that went into place last year. Actually, it's the 3rd year of this pilot, come to think of it. And what's that mean? Well, around 60 million W-2s will include a unique 16-digit alphanumeric verification code. And by the way, that's going to represent about 25% of all the W-2s that are out there. But why are they doing this? Well, the idea is ultimately so that they can match up the W-2 information better. So there's a verification code. But for you as a tax professional, what it means is you'll want to enter the verification code in box 9 of the W-2. So if your taxpayer has that verification code, please, or that information is found in the W-2 that came, what you'll want to do is make sure that that is entered into the W-2 form in the software. Okay. And again, the verification code will be used to help validate the authenticity of the W-2. That's why the government's doing this. It's just one more checkpoint that they've put into place. Okay, the last thing we want to talk about, and we actually had it right at the header when we're talking about, or the first thing we wanted to talk about when we were going to do this webcast, is some broader security expectations that are view the tax professional. And this is important for everyone to know. The IRS is really taking this seriously, and you know what? There's a reason why, because fraud is very serious, and people are getting into a situation where, you know what, there are cyber criminals out there, and if they get the hands on records of people, guess what? This is not good for anybody. So what's their concern? Well, that cyber criminals, they take over a tax preparer's computer system, and they obtain taxpayers' personal information. Therefore, it only stands to reason they'll commit tax identity theft as well as other forms of identity theft. So the IRS has a concern that this is one of the areas in which cyber criminals can get to the information of an individual, not just for the sake of the tax return, which is bad enough in itself, but of course there's so much personal information that can be found on a tax return. So the legal responsibility, and this comes with the territory when you're a tax professional, is that you have to safeguard the taxpayer information. That is part of what it is that you have a responsibility to do. and therefore is the expectation of the IRS that preparers take the appropriate steps to protect their computer systems, as well as any other avenue of theft on behalf of their clients. Again, to safeguard that type of thing it's your responsibility, and it's even going to be part of your brand that you can take good care of these types of things. Obviously, it's something that you'll want to be very, very aware of. So, because the IRS, and this is just a little bit of background, the IRS, the states, even the software companies such as ourselves have taken steps to reduce identity theft. We were all given mandates. We've all adhered by those. The next logical place that cyber criminals would look to attack is literally at the preparer level. So it is proven that the taxpayer's computer has been taken over and subsequently identity theft occurs. The tax preparer will be penalized, literally either directly or indirectly. Obviously, if it's directly, it's because, you know what, they're called upon it by the government, but even indirectly. So if somehow your computer's taken over, things are hacked, people get your information, it is not going to bode well for your brand, and therefore it's going to be very difficult for you to stay in business as a tax professional. So it is the responsibility of the tax preparer to take the computer security seriously by taking the appropriate steps to secure your system from hacking, from phishing, and from any other means that cyber criminals may have of taking over your data. So what are some of the things that you need to do? Well, let's take them one at a time. Your initial steps is you need to be alert for phishing email scams. You do not want to open up anything that you do not recognize as far as an email is concerned. On top of that, run a security deep scan of your systems to search for viruses and malware. This is a normal, logical business thing to do, especially if you have records of customers. And of course, since that's the case, you'll want to make sure you're doing these deep scans to make sure that there's nothing that has gotten into your software itself or even onto your computer itself. Okay. Strengthen your passwords for both computer and software access, and review any software your employees use to remotely access your network. In fact, I think it's a good idea to kind of make sure that you're checking what kinds of software your preparers, even in the offices themselves, are using at any given time. On top of that, you'll want to make sure you avoid downloads from suspicious sources. Certainly, if there's a link on an email that you received and you don't recognize it, you do not want to download that. On top of that, you'll protect your wireless network as well as use encryption software. Always make sure you lock or log off your computers, as well as make that an expectation of all of your preparers in your office. That includes if you have preparers that are working remotely. They need to lock or log off, and you'll want to secure all client data. And finally, make sure you shred outdated or not needed documents. Because again, you know what? It's about the computers, but it's also your brick and mortar. It's also your location, whether you're working remotely or you're working in an office itself. Please remember, all those types of things can be hacked or gotten a hold of by a cyber criminal. And you know what? Sometimes it's not even a cyber criminal. Somebody goes through dumpsters in the back and they find out information. Again, you as the tax professional responsible for securing your taxpayer client information. Next steps. After that, once you've done those things, please read and become familiar with the IRS publication 4557. This is a very interesting read, and I know how busy it is right now, but you can't take this too seriously. You really cannot take this too seriously. You'll want to make sure that you are very familiar with safeguarding taxpayer data. This publication will include quite a bit of good information. Checklists that help assess the risks to a taxpayer data in your office. It'll include information on constructing a plan for safeguarding taxpayer data. It will include information on additional things to consider as your business grows or changes. And of course, this might include information as to whether or not returns are being done remotely. And on top of that, there's some additional resources that can be found by simply Googling things. In other words, if you go in and you Google the following: IRS security awareness tax tips or identity theft information for tax professionals, protect your clients, protect yourself, data theft information for tax professionals, recognize phishing email scams, don't take the bait, or even information, you can go ahead and Google the Security Summit, the 2017 National Security Awareness Week tips. All of these things are going to help you as you're taking on the responsibility of making sure your taxpayer information is secure. And I said this before, but it's a great place to kind of finish this up with. You got to remember that you have to know that the security of your client's data is literally part of your brand. It is how you will be seen. And if it comes to, you know what, you are seen as somebody that takes good care of that private information and personal information of the taxpayers, they'll be much more likely to refer their friends than if there's ever an issue. So with that, we're kind of at the place where can turn it over and see if there are any kinds of follow-up questions. Again, I have Mark Castro, who is our liaison working with the federal government on a lot of these particular issues. So I'm going to turn it back over to John. And John, you can field any questions that we might have gotten from our audience today.
Thank you, Steve. I know that was a lot of information to cover in a very short period of time. Thank you for those of you on the call. We know that's a lot of information to take in. While we're waiting for those questions to be typed in the questions dialog box, look at your screen and you will see our social media pages. We'd like to invite you to join the conversation with CrossLink. And what we emphasize on all of our webinars is that we don't really use this to market to you. Rather, this is used to keep you updated on the latest happenings within the tax industry, tax law changes, some of the information we're covering today, updates to the software industry happenings that are relevant to you. But honestly, some of the most important, most valuable information we put out there is the exact topic we are covering today, which are tax updates. And so we invite you to join the conversation, subscribe to those pages, and you will get that information. With that, we've got a few questions coming in. Steve, we're focusing a lot on the tax law, but obviously we are a tax software company. One of the questions that's come in is, what, if anything, does CrossLink Professional Tax Software do, the 1040 product do, to help them ensure that they meet their due diligence requirements?
Well, the due diligence requirements themselves are something that you have great control over as the tax professional. Let's go ahead into the program real quick and we can show you. So itself, obviously, you have your due diligence checklist and all that good stuff. And I can go ahead and I could add my form and I can bring in the 8867. So here's all the information right here. But on top of that, please note that in your setup, when you're setting up your office, one of the things that you're able to do is you can go to setup, you can go to office setup, and when you're in office setup, please note that there's authorizations and audits. And this will allow you to really extend what it is that the questions that you ask with regard to whether it be earned income tax credit, head of household, Schedule A, so on and so forth. All of these can be found here. And as an example, if I want to go to earned income tax credit, I can check which kinds of questions will be asked as part of the due diligence. It's a great way of kind of seeing what it is that you want to do. And I always say that if you have a brand new tax professional working in your office, make sure you're checking all of these boxes. It's for their security and it's certainly for yours, or it's to ensure that your business is doing what it's supposed to be doing. So again, your authorization and audits is a great place to start with regard to that type of thing.
Excellent. Thank you, Steve. Next up, and for Steve and Mark here, if the IRS is matching all W-2 information from EITC returns, what does that mean for self-employed returns with EITC? Will their returns be delayed?
So yeah, this is Mark Castro, and I'll answer that. For self-employed returns, Schedule C's, IRS doesn't match those. They just send it through their regular process to look at the Schedule C to make sure it looks halfway reasonable. And if there isn't any problems, they're not going to delay the returns on Schedule C's unless they see something that looks suspicious. Then that will go to their error processing system, and a notice would be sent out if they have a question on it. Otherwise, because they can't really match the information on the Schedule C's as they can with W-2s.
Excellent. And folks, these are great questions coming in, so keep them coming if you have additional questions here. Form 8862, this is probably a question for Mark. I believe this is EITC related. The question is, do they have to add that to every return?
No, they don't. The 8862 is only if a taxpayer has been disallowed the EITC child tax credit or the American Opportunity Tax Credit in a prior year. So they, in order to be reinstated, they have to put in the 8862 with the information they need there. So it's only on those if they know the taxpayer has been disallowed one of the three credits in the past. This is to help get it reinstated so they can take the credit again.
Okay, excellent. Mark, we've been asked to explain a bit further in regards to the hurricane relief changes as it relates to special rules for EITC or the child tax credit?
So again, if the taxpayer lived in one of the hurricane disaster zones at the date of the time the hurricane hit and they were displaced because of the hurricane, then they can use the 2016 earned income to figure out their 2017 EITC or child tax credit, and that whatever one is to their benefit. They could also use 2017 earned income if they needed to, but the reason for that is just to make sure whichever one gives you the higher EITC for that. But hopefully that answers the question.
Okay. This one just has to do with the clarification of dates. The IRS stated last week that EITC and child tax credit refunds would not be released until February 27th, and I do believe that's the date. But according to this one here, it says that the presentation stated February 15th.
Correct.
Which one is the correct date?
Well, what it is the release will be on the 15th. That just simply means they're going to begin processing them on that time. We specifically said that the IRS was going to tell you, or has stated, that you can expect your returns to begin funding. In other words, money in accounts on the 27th. So we simply say the last week of February is when you can expect to see funding to begin. But again, that's because they're releasing them for processing on the 15th. So you folks were right that did see that the date of the 27th, but what that is that was the IRS telling you when you could expect to see things hitting accounts.
Yeah, and that's because, once the IRS releases the refund, number one, there's the holiday weekend. President's Day holiday is the weekend right after, and then it takes banks time to process the refund as well. So that's the reason why the IRS is saying the expectation is not to expect the refund until the 27th on those returns that the refund was released by the IRS on the 15th.
Okay, so to summarize, will be released on the 15th. Don't expect funding until 12 days later.
That's correct. It could be earlier than that, but don't expect it. That's what the IRS is, because of these different processing times of banks and other things that might hold it up.
All right. Very good information. Good information to convey to your clients as they begin to walk into your offices looking for status on their refunds and whatnot. You might have stated that the 8867 can only have 4 occurrences on a return, and someone was looking for a bit more clarification around that.
Okay, so the IRS allows 4 occurrences of the 8867 because questions 1 through 8, which relates to all 3 credits themselves. So if an answer on question 1 through 8 would be different for one of the credits, if you had all 3 on the return, then you would have to have a separate occurrence of the 8867 in order to answer that question differently, because there's only one answer now on each 8867 for all 3 credits. So that's the reason why you could have the 4. Also, the IRS, if more than one preparer was responsible for filling out the due diligence questions for one of the credits, they're responsible for the EITC, for example, then each preparer that did it would have to enter their PTIN. So that's the reason why there's 4 instead of 3. So again, it's 3 occurrence. You can have up to more than one occurrence if their questions are different on questions 1 through 8 for the credits.
Okay, excellent. Well, folks, that covers the questions that we've received. If you have any further questions, we encourage you to reach out to your CrossLink team. A couple of things we'd like to do right now before we wrap up is once again draw your attention to the screen. Join that conversation. A lot of important information, including much of what we just covered, is there. We know that this is an extremely busy time of year for everyone on this call. We'd like to thank you for taking the time to participate in this. We hope you found this extremely helpful. And with that, I'm going to turn it over to Mr. Kratzke to wrap this up for us. I
just want to thank everyone for joining us. John's right. It's a busy time of year. However, The tax professional that's in the know has always got an advantage. So appreciate your time. Mark, thank you so much for your input as well. And we'll wish everyone a great tax season at this point. Thanks, everyone.